Look at where we are today versus where we're going to be in 2025 and in 2030, the industry is poised to grow by about 7,000%. So that's almost incomprehensible to think about that number, but the industry was quite small before and really has started to rapidly accelerate in growth as major automotive manufacturers have really made investment commitments to the industry itself. I think that's also been bolstered by positive policy in Europe and in Asia, and now in the United States. So we're really on the precipice of a really exciting growth for the lithium industry in general.
What is up, guys? My name is Ignas. Welcome back to the channel. We have been looking into financial companies recently, but now I want to turn to materials and in particular lithium. So lithium is used in a wide range of consumer products, starting from smartphones to electric vehicle batteries. A few weeks back, John Evans, the CEO of Lithium Americas, went on Yahoo Finance to discuss what's next for the booming lithium production. This is what he sees going further.
We won't be the only ones. There'll be additional operations that'll be needed, but if you look at the demand today, if you look at the amount of electric vehicles, battery density, it's about 30,000 tons of demand today, this year. It'll go to over 100,000 tons in 2025, and then it'll be 350,000 tons just for the United States by 2030. If you look at the industry today, if you look at all the capacity in the world, if it was on right now, that's about 600,000 tons. For an industry, if I look at the total global demand by 2030, it's nearly 2 million tons. So there's a bit of a race, and there's especially a look now to develop and to localize supply chains. I certainly don't advocate the United States is going to be completely independent, but I think it's important for the U.S. to have domestic supplies of lithium, not only to supply the automotive manufacturers, but also to spur growth of the other areas of the supply chain around cathodes, anodes, and other aspects of batteries in general.
So the prospects for lithium demand looks great so far. By 2030 it will increase to around 2 million tons, so that is a forecasted over 3x increase in less than a decade. This means that every company involved wants to be the first to be the supplier for this need. So for the comparison today I have picked 3 lithium producers. These are Albemarle Corporation, ticker symbol ALB, Sociedad Quimica y Minera SQM, and Livent Corporation, ticker LTHM. In order to make the comparison possible, we will be looking into 8 different factors: analysts' price targets, forward price to earnings ratio, annual revenue growth, price to sales ratio, return on equity, last 4 quarter earnings results, current ratio, and dividend yield. The best company under each factor will get a point, so it is possible to have from 0 to 8 points, and in the end the stock with the most points will be considered the winner of this comparison. I hope that the rules were clear, so let's begin. First factor we have is the analysts' price targets. As investors, we want to check how far the current share price is away from the average target of analysts. If the current price is under the average target, we will consider the stock as undervalued, and in the end, the company with share prices furthest away from the average analyst target to the lower side gets a point for this factor. For Albemarle, we have 20 price targets of analysts. They range from the lows of 61 to the highs of $216 per share. The average is at $162.13, and the current share price is at $169.87. This means that the current price needs to go lower for around 4.6% in order to reach the average target of analysts. For SQM, we have 10 price targets of analysts. They range from the lows of 38 to the highs of $70 per share. The average is at $53.66, and the current share price is at $46.40. This means that there is still around 15.6% room for the current price to reach the average target of analysts. For Livent Corporation, we have 11 price targets of analysts. They range from the lows of 12 to the highs of $24 per share. The average is at $19.18, and the current share price is at $20.89. So the current price needs to go lower for around 8.2% in order to reach the average target of analysts. Results for the analysts' price targets factor are in the table, and with most room to average target, SQM gets the first point. The second factor we have is the forward price-to-earnings ratio. It is calculated by taking the current share price and dividing it by the estimated future earnings per share. This is the standard price-to-earnings calculation with the difference that earnings here are predicted by analysts. So in the end, the company with the lowest forward price-to-earnings ratio gets a point for this factor. For Albemarle, the forward price-to-earnings is at 33.37. Forward P for SQM is at 25.92. And Livent has a forward price-to-earnings at 59.69. Forward price-to-earnings ratios are in the table, and with the lowest value, SQM gets another point. Third factor we have is the annual revenue growth. As investors, we want to find that the revenues of a company are on a steady increase. We will take a look into the revenues of the 4 most recent years and compare them one by one. If revenue was on the increase from one year to the next, we will consider it as a +1, and if it was on the decrease, it will be a +0. Then we sum the results up to a minimum of 0 and a maximum of 3, and in the end, the stock with the highest sum gets a point for this factor. We have annual revenues for Albemarle, and going into 2018, there was an increase to $3.37 billion. Then into 2019, there was another increase to $3.59 billion, and going into 2020, we had a decrease to $3.13 billion. So with 2 increases and 1 decrease in annual revenues, we get a sum of 2. Annual revenues for SQM, and going into 2018, there was an increase to $2.27 billion. Then into 2019, we had a decrease to $1.94 billion, and going into 2020, there was another decrease to $1.82 billion. So with 1 increase and 2 decreases in annual revenues, we get a sum of 1. Revenues for Livent Corporation, and going into 2018, there was an increase to $442 million. Then going into 2019, there was a decrease to $388 million. And going into 2020, we had another decrease to $288 million. So with 1 increase and 2 decreases in annual revenues, we again get a sum of 1. Results for the annual revenue growth factor are in the table, and with the highest sum, Albemarle gets the first point. Fourth factor is the price-to-sales ratio. It is calculated by taking the company's market cap and dividing it by the trailing 12 months worth of sales. The formula suggests to be looking for a company with a low market cap and a high result in sales. So in the end, the stock with the lowest price-to-sales ratio gets a point for this factor. Albemarle has a price-to-sales at 6.16. Price-to-sales for SQM is at 6.25. And Livent has a price-to-sales at 9.83. Price-to-sales ratios are in the table, and with the lowest value, Albemarle gets another point. Fifth factor is return on equity. It is calculated by taking the net income and dividing it by the shareholders' equity. A higher ROE shows that the company is well managed and that money from investors are efficiently handled. So in the end, the stock with the highest return on equity percentage gets a point for this factor. For Albemarle, the return on equity is at 8.83%. Return on equity for SQM is at 8.96%, and Livent has a return on equity at -3.31%. Return on equity percentages are in the table, and with the highest value, SQM gets 1 more point. Sixth factor we have is the last 4 quarterly earnings results. When a company reports earnings, they are compared to expectations of analysts. So earnings can either beat expectations, meet them, or miss them. We will consider that beating expectations is a +1, meeting +0.5, and missing 0. Then we sum the results up to a minimum of 0 and a maximum of 4, and in the end, the stock with the highest sum gets a point for this factor. We have quarterly earnings for Albemarle, and Q2 of 2020 beat expectations, Q3 beat, Q4 beat expectations, and Q1 of 2021 beat. So with 4 beats in quarterly earnings, we get a sum of 4. Quarterly earnings for SQM, and Q1 of 2020 missed expectations, Q3 missed, Q4 beat expectations, and Q1 of 2021 beat. So with 2 beats and 2 misses in quarterly earnings, we get a sum of 2. Earnings for Livent, and Q2 of 2020 missed expectations, Q3 missed, Q4 missed expectations, and Q1 of 2021 beat. So with 1 beat in quarterly earnings, we get a sum of 1. Results for the last 4 quarterly earnings factor are in the table, and with a sum of 4, Albemarle gets another point. Seventh factor is the current ratio. It is calculated by taking the current assets and dividing them by the current liabilities. As investors, we want to find that the company is able to cover its debts with assets, but also that they are actually being leveraged. So in the end, the stock with the highest current ratio between between 1.5 and 3 gets a point for this factor. Albemarle has a current ratio at 2.11. Current ratio for SQM is at 5.12. And Livent has a current ratio at 4.01. Current ratios are in the table, and with the highest value under 3, Albemarle gets 1 more point. The last factor is the dividend yield. It is calculated by taking the annual dividend per share and dividing it by the share price. A high dividend yield may suggest that profits are being shared with shareholders, and that is a great passive income source that we as investors are looking for. So in the end, the stock with the highest dividend yield percentage gets a point for this factor. Albemarle is currently paying an annual dividend of $1.56 per share, which is a yield of 0.9%. Annual dividend for SQM is at 95 cents per share, which is a yield of 2.08%. And Livent Corporation is currently not paying any dividend. Dividend yields are in the table, and with the highest percentage, SQM gets another point. We can calculate the results, so Albemarle has 4 points, SQM 4, and Livent 0. This means that we currently have a tie between Albemarle and SQM. In my opinion, SQM may be more hyped up by analysts. We can see that in their high price targets, and also the optimistic prediction in earnings. On the other hand, for Albemarle, we have a better price to sales ratio, and they are consistently beating analyst earnings expectations, with 4 beats out of 4 quarterly earnings. That is why I'm giving an extra point to ALB, and we may consider it the winner of this comparison. So that was it. If you got value or new ideas, then make sure to push that thumbs up, it helps the channel a lot. Now there is a question for you: which lithium producers are you most interested in? Share your picks in a comment below. If you are interested to know exactly when I buy or sell in a stock, then consider the options on Patreon. Last week I did a stock comparison on large financial companies with Visa, MasterCard and American Express, and we also have 41 week worth of investing with the Revolut stock portfolio. If you are interested in any of these, then click on the video currently on the screen. And that was it from my side. Thank you for watching, and I will be seeing y'all in the next one.